Welcome to Jazz After Dark, everybody. How you doing out there? All is good? I'm feeling good enough here today where I've got my drink ready to go. I'm going with the Clyde Mays Alabama style whiskey. It's growing on me. I'm actually really starting to like it. Very, very honey, vanilla, caramel, lots of good stuff going on in there. Never had it before. Had it the other day with you guys, and yeah, pretty good. So enjoy. Hang out with me, grab a drink. This is our sort of deeper dive kind of a class. We just lay back, right? We're just hanging out. This is not the quick tips type videos. We're going to talk about something tonight. We're going to go into the woods a little bit. I'm going to scare you. It's going to look like a Rorschach test. Trust me, this is going to look intense. But I'll explain it. I love explaining things that are pretty complicated in hopefully an easy to understand way. So I'm going to start by asking a question. When, not if, but when the markets fall, how far do you want them to fall, right? I say this now because the markets are doing really well. Right? Everything's good. So if we talk about like chaos when times are good, you're able to absorb it and go, yeah, actually, yeah, it's not going to be a problem. I'm going to make it, right? Now, remember, we always want to position our investments ahead of this. We never want to be caught off guard and go, well, I didn't know I was going to fall so much, right? I was just enjoying the good times. So that's the most important thing. If you're working with us here at Jazz, I got you covered. If you're working with another advisor, just ask the question, hey, if the markets fall 10%, how much will I fall? And it's an easy thing to it should be an easy thing to calculate. And then keep going. Well, what if we fall 20%? That's a different animal than falling 10%. So you can't just say, well, if the markets fall 10, you're going to fall 8 or whatever. Well, the difference between the 10 and the 20% drop, whole different animal. That's usually when the whole market starts participating. So you know that? So when the stock market falls 10%, it can do that. Like right now, it could do that if Meta, Nvidia, Alphabet, Amazon, Tesla, Apple, if those stocks just have a little bit of a pullback, that could be enough to give us a 10% pullback. And the rest of the market could look pretty good, right? You could have utilities holding up, healthcare holding up, real estate maybe holding up in there. But once you get past the 10% level, I don't know, I don't make the rules here, but once it goes past 10%, that's like throwing in the towel type stuff. Usually everything goes with it at that point. There's a few outliers, of course, but that's usually where you see that real meat and the whole market just start to fall. So when someone tells you, well, if the market falls 10%, you'll fall 8. Okay, hey, what happens if we fall 20%? That's a different game. That should not be, the answer should not be 16%, right? It should not be that. So something they can look into. But my question is, when the next like chaos of whatever hits the market, how far is a good distance for the markets to fall? You might say like, well, how far has it fallen in the past, right? Could it do the same again? Could it be worse or whatever? Yeah, of course, I don't know. But you go, well, is there a point where when the market falls, I'm pretty much, or historically, guaranteed that the markets will recover by a certain amount? Ooh, now we've got something, right? So hang with me here a little bit. I'm going to use an example. I know it looks scary. This is not complex, right? Let me just break it down here. I couldn't figure out how to flip it, so we're doing it this way. So on the x-axis down here at the bottom, we're saying, okay, well, how far from a high, because we're at 52-week highs now, right? I mean, we are, at least as of this filming. So how far did we fall from that high? So we're going, did we fall 10%, 20%, 30, and so on, right? You can see that the bulk of pullbacks are pretty minimal, and I should say bear market type pullbacks, right? Where we have 20% pullbacks. All right. The majority of instances are in here, okay? Now, the y-axis in this case is saying, okay, 1 year forward, what were the returns, all right? So for example, if we go out to, let me pick a outlier here. We go back into this, the 2000s, right? Where we had that, the financial crisis. What we're showing here is if you look at this last little dot, that at one point the market had fallen over 50% from its highs. If you're from that financial crisis days, you remember. Okay, but a year later, it was up over 60%. almost pushing 70%, right? Now I get it, right? If the markets fall 10% and then they gain 10%, that's still a loss for you, right? You know that number there? You've seen that? I think Susie Orman was the first to really sort of publicize that in a real like broad way. But anyway, so I get that part. All I'm saying is at this point, we had fallen over 50%, and 1 year later, we had positive gains of 70% or so. Okay, fine. So, what I want to point out here is if the markets fall 10%, there's a 50-50 shot that a year later you will have a positive gain. Okay. Well, then I want more than a 10% pullback, right? If we're going to do it, let's knock it out. How far do we have to go where I can say with certainty every single time in history the markets have been higher? Well, this red line here is just our last decline, right? So this goes back to October of last year. We had that pullback. It's about 25%. So it fell about 25%. And we said, well, how many other times was the market higher? Well, the odds were the market was going to be higher a year later, and it is higher a year later, but looking back through history. Well, follow it. Just go all the way over and go, at what point are there no more negatives, right? So over a 1 year time span, if you land at 34.1%, there is no time in history where the market was lower 1 year later. So that could tell you numerous things. That could tell you, well, just, grin and bear it, and I'll recover some or all of my losses. Okay, whatever. But also tells you that, hey, if we have a severe pullback, you want to be buying that. And it's not my opinion now. So I've taken that out. We're saying you want to be able to buy that in some fashion, dollar cost averaging, big lump sum deposits, whatever you do, you want to be able to do that. We say, all right, well, this is every instance. It's color coded for you. So if you really want to stop here and kind of see that this is accurate and we're talking about the COVID declines and all that stuff, that's just a way for you to visualize it instead of it being a bunch of gray dots, So your boy took the extra step. All right. So we know that if you're only interested in somewhat of the short term, right, you get about a 34% pullback, then 100% of the time, 1 year later, the market was higher. I get it. Maybe this time's different. You know what I mean? I have to say that. Let's take it out further. For those of you that are longer term investors and you go, hey, I don't like this market up here. I want it to pull back to some degree. Well, let's do the same thing, but let's look out 2 years. All right. Exact same thing, well, not the exact same data, right? Because it's a little different, but we're doing the same layout. So work your way this way. This is the October decline. If you want to just see kind of what happened when we fall 25%, but you work your way over and say, okay, well, that's the distance that we've fallen from highs. And this is now the 2-year forward performance, positive or negative. This gets a little more pronounced, right? So if we fall 10%, there's a better than 50-50 shot that we're going to be positive. And this is just visual, right? You could kind of look and see like there's less dots here. There's a whole lot more here. So the forward performance was leaning towards the positive side 2 years later, right? For the long-term investors. Well, now let's look at this. So we go over to the 25% mark where we had our October pullback there last year, the 2022 pullback. And we say, okay, well, falling 25%, there's only a handful of times that I would have been in any real trouble. And they fell in some various bull markets that we had along the way. So blue indicates that we were in a bull market at the time that happened. All right. Well, if you shift a little bit over, you go, okay, well, what point do we no longer have any negative forward returns on a 2-year basis? You only have to get to 31%. I get it. That's a huge decline, right? That is not normal, right? So that's why there's not a billion dots on the screen. But if, by chance, we fell 31%, then 100% of the time, the markets were higher to pretty severe degrees, I might add, over a 2-year time period. What does that tell you? Well, over a 2-year time period, that would have been worth it for you to buy it, to really dive into your portfolio. Maybe you didn't have any money. And you said, well, okay, the market fell, 31%. I know it's going to be good for me 2 years going forward. That's the time to look at your net worth and go, these dollars I won't be touching for a long time. I want to make sure those are aggressive. I want to participate in every ounce and preferably more that the market has to give in this 2-year window going forward. These dollars, you might go, look, I need that. I'm about to retire. I'm about to buy a house. I have short-term goals. I can't be risky with that. Look at your entire portfolio and go, great, when we have that next pullback, these dollars better be just going for it, man. Get everything you can, because we know that the market doesn't like to fall to this degree, right? It does like to fall 10%, a whole lot. This is all just a bunch of gobbledygook, right? But if it has these extreme declines, these are the financial crisis, the oil crisis, the wars, the September 11th, all that stuff that we've been through. I don't wish that on the markets, the economy, or on you, but it's going to happen again. There's going to be something that causes us to throw in the towel, panic, just widespread selling. And I want you to be able to look at it from a position of strength and offense. Okay, I don't have any money. I lost my job. The economy tanked. The stock market fell. What do I do? Well, you still have your investments. This piece can be aggressive. This piece should stay the same. This piece, we should just be playing it safe, right? Think about that. What kind of aggression can you have with your long-term investing if you have the data? And that's something we're really big on here is data drives what we do, right? I'm not saying we know everything, but I'm saying we're not just going to wake up and go, yeah, I got in a fight with my dog last night, and therefore I just want to sell everything for every client's portfolios. No, there better be some good data to drive those decisions. So when there are pullbacks in the market, who do you think is going to be swinging for the fences with the money that we can swing for the fences for? Jazz Wealth, right? All right. So I'm still getting better. I'm really puffy in the face, and if you don't know, I've had a on and off weird kind of viral sickness there, not COVID or anything, but just I was out of it, man. So I'm playing catch up a little bit, but I wanted to bring this to you because I love talking about this now instead of when the markets are falling, because I've lost you then, right? You're not paying attention then. You're like, wow, I had this much money. Now I have a lot less. So if we talk about it now, maybe that gets you something you can work on. All right. Hey, enjoy your night. See you soon, right?